Then this was in 2022 that we were already pretty much in the biggest bubbles in history in all asset classes except gold and silver. And I keep on repeating, the higher the cliff, the bigger the fall. In order to get back to just realistic levels where the financial sector is in balance with the rest of the economy, right now, the Federal Reserve has warped the economy to unprecedented, dangerous levels, and it is 100% the Federal Reserve's fault. And so this crash, just when it comes, and it will, it isn't a matter of if, it's only a matter of when. When it comes, just realize two things. That this is Ben Bernanke's fault and the Federal Reserve's fault. It isn't the market, the free market. When they scream, oh, the free market isn't working. No, it is working. It's overwhelming the manipulation that they did, the bubbles that they caused. This is the inevitable result of their actions. And what's worse is their reaction to the market trying to correct and overwhelm their manipulations is going to be more manipulation, just setting us up for something worse the next time. The more that we look at all of the data, the more that I think that we are in for the greatest crash in history, possibly worse than 29, because we've got the phoniest monetary system. And if they're able to stop the crash this time, it's just going to be, the QE5 is going to be the biggest print in history. And my update to my original book talks about the financialization of government. As markets collapse, so does government revenue. So deficit spending will be going off the charts. So the amount of currency that they're going to print this time around is going to be astronomical. But another thing that I want to say about this, you notice that after a crisis, this shrinks. Why does it shrink? These are money markets. This is supposed to be parked currency that's in a safe haven bet. And where does it go? It goes to places like gold. There's $7 trillion, 7.5 trillion sitting on the sidelines that could seek a safer haven than this supposed safe haven. It's nothing but an IOU. It has counterparty risk. It's not the real safe haven investment. This 7.5, when this goes south next time, a lot of it is going to be headed toward gold and silver.
Exactly.
Central banks now act inside markets, shaping risk premia through rates and balance sheet operations. Quantitative easing and fiscal backstops altered investor incentives, favoring large positions in financial instruments over productive capital formation. Valuations detached from cash flows, corporate leverage climbed, and the economy rewarded ownership of existing assets more than production. These distortions compress yields, encourage reach-for-return behavior, and lengthen the list of entities reliant on accommodative policy. Over time, policy became an input to asset pricing rather than a background condition, engineering price behavior and storing instability in the system and credit.
Get your real assets while you can.
Yep, cover your assets.
Cover your assets. Shocking stat of the day. The bottom 50% of U.S. households now hold just 2.5% of total U.S. wealth. Yikes. History says rate cuts with stocks at record highs will lead to even more record highs 12 months from now. Asset owners will party and the wealth gap will widen, especially as core CPI inflation is back above 3%. Okay, so the bottom 50% of households hold 2.5% of U.S. wealth. And by the way, that's not the orange section here. It's actually, because that's the 50 to 90th percent. The bottom 50% is the light blue at the very bottom of this chart that you almost can't even see. Okay, that's the bottom half of households in America owning just 2.5% of wealth. Meanwhile, all the other category groups are rising exponentially. So the bottom half of Americans are getting left behind because of all the phony baloney currency created out of thin air.
Yeah, there's a couple of things that I see in this chart that I want to point out to people. First of all, as we grow the currency supply, and because this is measured in trillions of dollars, right?
Yes.
180 trillion. There's a T after it up
Mm-hmm.
there. And so being measured in trillions of dollars, as we grow the currency supply, this thing goes up. And because it's going up, it makes it, because the currency supply keeps on getting larger, that blue area, if you go back before 2008, it looks like it starts out really small and gets bigger. It probably doesn't. If this was a logarithmic graph, what we would probably see is that this was biggest in the 50s and 60s, and it's been shrinking ever since Nixon took us off of gold.
Over recent decades, most new financial gains accrued to asset owners, equity holders, bond holders, and real estate investors. Median households stagnated while the richest tiers captured outsized returns because they held instruments that benefited most from easy money. The bottom half of households now control a tiny share of national wealth, producing redistribution that weakens mobility and fuels political tension. Wealth concentration alters consumption and investment patterns, reducing systemic resilience and raising the cost when markets reprice. Knowing who holds wealth is essential for realistic policy choices and personal planning and retirement savings.
And then what you do see here that's amazing, that you actually shouldn't see because of how this chart is going exponential. Actually, I got to flip that for the audience. It's going exponential. Is that in 2008, it sort of hits a maximum, and then we get into the global financial crisis, and Ben Bernanke changed the way currency is created in the United States when he introduced quantitative easing. And it enriched anybody that gets their net, when they determine their net worth by the size of their stock portfolio, when their net worth is based on financial assets such as investment real estate and stock portfolios and bonds and so on, instead of the house that they live in and their savings account. That bottom blue line there, the bottom 50% being squeezed to just 2.5% of the wealth, that's a collapse that has been caused by one man, Ben Bernanke, and it just shows you that central planning doesn't work. He central planned the entire world monetary system. Everything changed. All the other countries jumped on board with him. It is his fault. The bust that we are about to have is the Bernanke bust. But Janet Yellen carried on the tradition, and Jerome Powell took over from her. The only thing that these people know is take interest rates down to zero so that the banks create more currency and light up the printing presses at the Federal Reserve. That's all they know. And they truly should be ashamed of themselves because they did this. They impoverished the bottom 50%.
When risk perception spikes, capital hunts for perceived safety. Cash is only as secure as the issuer, and modern fiat carries policy and counterparty risks. Historically, investors rotated into tangible stores of value, precious metals, defensive real assets, and certain safe income instruments during severe corrections. Today, substantial pools of near cash sit on the sidelines, latent buying power that can pour into these havens when faith erodes. That migration accelerates price discovery for tangible assets and forces sharp repricing across paper markets, sometimes in compressed time frames. Timing and sequence matter greatly.
Yeah, absolutely. And the bottom 50%, generally speaking, have no idea what's happening, right? They blame themselves, each other, a different political party, foreigners. They just pick a scapegoat, and they don't understand that it's the money. And this is what kills me the most. It hurts so bad. It's like, if we didn't have, Nixon and then the central bankers you talked about, if they didn't do all this, the bottom 50% would already have a tailwind helping them of sound money. And they wouldn't have to struggle to survive. Life would be so much easier for everybody.
Right. Today, the way currency is, well, it's always been this way under a fiat monetary system. But whenever they create currency, whenever they do something to react to a so-called emergency, instead of letting the markets clear out the excesses and start, you go through a really bad recession, and then you start from a fresh, sound foundation, and you go into the next bull market. When they do all of this hocus pocus like quantitative easing, you've got this crumbling foundation. They slap Band-Aids on it, and then they inflate the next bubble. What it does is it steals from that blue line at the bottom, and it gives to the people in the red and the purple lines. They are the beneficiaries from the collapse in the blue line. It's just plain theft. These people should actually be in jail. I'm sorry, the people at the Federal Reserve, people doing this. This is theft, and it's enslavement too, because the people that lost that blue line, they have to work harder to make up for what's been stolen from them.
Exactly. I completely agree.
If you go to GGSR 21, and along with in chapter 4, the hardest chapter in the book.
Across markets today, multiple indicators sit at historic peaks. Equity indexes, house prices, cryptocurrencies, gold, broad money aggregates, and federal debt. Those simultaneous extremes compress risk premia and expand systemic vulnerability. Correlation rises when everyone chases the same risk signals. When monetary and fiscal responses have already pushed measures of money and debt to records, policy space to react may be limited or distortive. Investors should note that alternative stores of value have also advanced, reflecting doubts about paper money and prompting cross-asset reassessment that can be abrupt and disorderly, and geopolitical tensions rise.
So read chapter 3 first. It's going to take you 15 minutes or a half an hour, and it's fun. Chapter 4, hard. It's busted up into 8 sections, and the 7th and the 8th section, watch the videos that go along with that, because I take a detour away from the book. There's information in there that you're going to want to know about wealth distribution, and you can very clearly see what causes this.
Exactly. And that reminds me, Mike, of my upcoming series, Hidden Secrets of Value. Inspired, of course, by yours, Hidden Secrets of Money. And my first episode is saving versus investing. So if you just hold gold and silver, I think of that as saving. And that's what people have been able to do for thousands of years, is just hold the money they earn. And this whole nonsense of trying to pick, do I buy stocks? And if so, which ones? Or bonds or real estate? And just spending all this time and energy figuring out what investments to hold is just wasting everyone's life. I mean, you traditionally could just save the money you earned, and you still can. You can still just save gold and silver and then forget about the quote unquote investing. So I've got a series coming up. It's going to launch next month in October. And this is the first episode here. So I'm super excited about it.
Excellent. Awesome. Talking about the monetary system, if we were using something of limited quantity like gold, where it grows at about the rate of the population, maybe a little bit more, maybe a little bit less, we would experience a world where there wasn't this constant wealth redistribution from the poor and the middle class to the uber wealthy. And what you would see is that you would actually be able to hold your gold or silver or whatever we used that was of limited supply at home. And it would be a somewhat deflationary environment where your purchasing power would increase constantly. Why? Because man gets more efficient. We figure out better ways of making things, and we are constantly more productive. Everything should naturally be falling in price, not going up. This is all an illusion that we live in, caused by the Federal Reserve.
If a deep correction arrives, the policy response and sequencing will shape recovery and distributional outcomes. More monetary accommodation risks larger future distortions. Stricter policy risks concentrated near-term pain. For individuals, the best defenses are practical. Ensure liquid reserves, reduce counterparty and leverage exposure, diversify into income-producing and tangible assets, and favor capital preservation over speculative leverage. Financial planners should stress test scenarios, consider duration, and model tax and inflation impacts. Societies will confront choices about monetary design, fiscal responsibility, and how to rebalance opportunity and risk. Transparency, restraint, and reform matter.
Exactly. I agree completely. And that was a huge epiphany for me when I realized that the CPI went down every year on average until 1913, creation of the Federal Reserve, and then it started going up. And then, in 1971, it started going up like a hockey stick.
Yeah.
So, yeah, sound money for the win.
And Wall Street is better off for it. The wealthiest people are better off, but not the average person.
Exactly. So we've got breaking news here. This has never happened before. S&P 500, all-time high. U.S. home prices, all-time high. Bitcoin, all-time high. Gold, all-time high. Money supply, all-time high. Public debt, $37.4 trillion, an all-time high. U.S. labor market in a recession. And the Fed is going to cut rates next week. Okay, so this is a little bit of old news here. What is happening here? So, yikes, Mike, this is a crazy setup. This is for the biggest crash in history that you've talked about for more than a decade. What do you make of all this?
Well, that is all that it adds up to. The labor market is in a recession. The Fed looks like they're going to be cutting rates. That adds up to there is an emergency right now, and we're in the greatest bubbles in history. If there's anybody watching this video that didn't watch my bubble whip video from a couple of weeks ago, please go watch it so that you understand where the economy is. We are teetering right, I talked about a knife's edge or on the edge of a cliff. And in my book, one of the, in chapter 5, you and I prove, then this was in 2022, that we were already pretty much in the biggest bubbles in history in all asset classes except gold and silver. And I keep on repeating, the higher the cliff, the bigger the fall. In order to get back to just realistic levels where the financial sector is in balance with the rest of the economy, right now, the Federal Reserve has warped the economy to unprecedented, dangerous levels, and it is 100% the Federal Reserve's fault. And so this crash, just when it comes, and it will, it isn't a matter of if, it's only a matter of when. When it comes, just realize two things, that this is Ben Bernanke's fault and the Federal Reserve's fault. It isn't the market, the free market. When they scream, oh, the free market isn't working. No, it is working. It's overwhelming the manipulation that they did, the bubbles that they caused. This is the inevitable result of their actions. And what's worse is their reaction to the market trying to correct and overwhelm their manipulations is going to be more manipulation, just setting us up for something worse the next time around.